Hey, this is Mike Swanson, Wall Street Window here. We've seen some interesting moves this past week in the markets. Really, they've kind of gone blah, 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 gone like that. Gold and silver acted stronger. Is this move that we've seen in the past couple of weeks, gold and silver for real? Gold up near $1,800 an ounce. Well, I wanted to talk with my friend Jordan Roy-Byrne about gold and silver. He runs the website thedailygold.com. We talked about an article that he put up a couple of days ago. So here we go to Jordan.
Thanks so much for having me.
Well, it's been an interesting couple months since we last spoke, and looking at gold has had a nice rally since October, but it's also rallied with the stock market. At the same time, it's doing better than the stock market year to date, much better. So is silver. So what's your take on what's going on?
Well, my take would be, to sum it up, Mike, is that I think we've seen a major bottom, an end to the cyclical bear market in precious metals, that we had that started at the end of summer in 2020. So I think that cyclical bear market is over. And I think that we're at the very beginning of a new cyclical bull market in precious metals. And I think it's also likely to be the beginning of a new secular bull market in precious metals. And even though precious metals, most of the last 6 years has been good for precious metals, the big issue is that the stock market has been rising at the same time. And so the stock market has been a secular bull market since '09. And if you look at the biggest moves in precious metals, they essentially have all occurred, all except one, have occurred during the periods when the stock market has been in a secular bear. So in other words, if we go back in history, 2000 to 2011, gold and silver performed very well. The stock market did not. I mean, it went sideways at the 2009 low. It was certainly down 50% or so from the 2000 high. And if we go back before that, we know that precious metals performed very well from 1970 to 1980. And the stock market was in a secular bear market during that time. I mean, we had rising inflation, rising interest rates. So common stocks did not perform as well. The same thing happened in the 1930s when you go back to the times when gold price was fixed. 1929 to 1942, that was the bear market in the stock market, the secular bear. Gold stocks performed really, really well from 29 to 37 in that time. So so the secular trend is really what matters. That's the driving force for the stock market and precious metals. When one is in a secular bull, the other is in a secular bear. So my thinking is that we are very close to getting confirmation that we're in a secular bear for the stock market. Now, to me, Mike, that would entail if we see a recession this year, we see the S&P go below the low at 3,500, the recent low. So if that happens, to me, that's confirmation that you're in a new secular bear for the stock market, and you're going to be in a new secular bull for gold and precious metals. And so I think that's really the big picture where we are. And I think in the very short term, I mean, you're correct that precious metals have rallied together with the stock market. And that's that's not what we typically want to see. But you noted that precious metals have outperformed. That is true. But I think that at some point here in the next, I don't know, it could be 2, 3, 4, 5 months. I think if we see the stock market roll over again and trade lower, you could see precious metals give back some of these gains. But at the same time, we need to see that for this real bull market to begin in precious metals. Because if the stock market rolls over, trades down towards 3,500 again, and a big reason for that could be because the market is starting to sense that a recession is coming. If that happens, you're going to see the Fed stop hiking rates, and eventually they're going to have to turn to cuts, and that's going to be the major catalyst for precious metals to do really well, while the stock market is still wrestling with the cyclical bear market that it's in. So I know that was a lot to take in, but that's basically my short and long-term view right now.
Well, I'm looking at the article that you wrote a couple of days ago titled Key Levels for Gold and Silver into 2023. And the first chart you have shows on the bottom of it the gold versus SPX ratio. Now, I wasn't investing in gold, much less trading mining stocks in the 1930s or the 1970s. I bought my first mining stock in 2002, and the gold market really did great, as you said, from 2000 2011. But most people really were oblivious to what was going on until 2003, 2004, and I wasn't paying attention in 2000 or 2001 what gold was doing either. So in a way, and really gold was going sideways, and silver was too. After bottoming in 2000, then they broke out, or gold broke out in 2002. So what I'm wondering is, with what you said in mind, could this year, 2022, be sort of a transitionary year, like perhaps 2000, 2001 were, that sets the stage for a more bullish environment starting next year? Like, I'm looking at your gold divided by gold versus SPX ratio, and it's up this year. So gold's outperforming the stock market this year, but the ratio, really has a sideways trend. So I guess, could that change? Does it need to break out to really confirm things, you think?
Absolutely, yes. It does need to break out to confirm that there's a new bull market in precious metals. I mean, that's going to be the key thing to watch. If I'm right over the next, couple months, and if we see weakness, we see a sell-off in the S&P, and the precious or gold miners follow the S&P, and they, not saying they're going to correct all the way back down with the S&P, but they'll probably correct a little bit. And so that, if I'm right, as that happens, I definitely want to keep my eye on gold against the S&P, the ratio that you're talking about. Because typically, when you have a correction in the stock market, gold is typically going to outperform gold stocks during that time. So that's something that I'm really going to be keying on over the coming months. But just a couple other things I'd like to touch on.
Sure.
Yes, looking at, I see a lot of similarities to the 2000-2002 period that you noted. First of all, it's really interesting because, think of like 1998, Russia was falling apart. There were currency problems there. Emerging markets blew up a couple years before. And it looked like markets, the S&P corrected, I think, 20% at that time. And it looked like markets were, we were going to have a real bear market and a real recession at that point. Well, the Fed came in and just pumped in a whole ton of money into the system and prevented that from happening. And so that, if we're using this analog, 1998 is very similar to 2020 and COVID, because we were probably going to have a nasty recession, but the Fed came in, pumped in a lot of money. The government, what was it, $7 trillion in stimulus? And remember 1999 to 2000, Mike, and the dot-com stocks?
Oh, yeah.
It was just ridiculous. I mean, these companies with no business, no revenue, they're valued at 20 or 30 billion. Well, that, we saw the same thing with Kathy Wood and, her ARK stocks, that ETF, and also crypto. I mean, crypto, what happened in crypto in the last couple of years perfectly mirrored what happened with the dot-com stocks in 99 to 2000. And so, yes, I see multiple similarities between what's going on now and what happened in 2000 to 2002. And also, if we're looking at the stock market, I've looked at the pattern of the stock market in the 6 worst bear markets, and so far this bear market, it's following that template pretty closely. I mean, there tends to be we're at the point where, if it continues to follow this template, at some point in the next couple months, the market should start to roll over, and it could get ugly if the market discounts a recession. Because if you look at what the historical data tells you, the worst decline in a bear market is when the recession begins. Now we can't. No, and this is based on the NBER and whenever they say the recession begins. So we're not going to know until after the fact. A year or two from now, they'll come out and they say, "Oh, well, recession started in, March, or it started in February or April." So we won't know exactly when. But the key point is, a month before the recession starts, like that period moving forward over the next 3 or 4 months, that is when you have the worst decline in a bear market. And so we could be setting up for that. As I said, at some point in the next couple months, if the market rolls over again and it really accelerates to the downside, that's your recession decline. That's the market discounting a recession. And we know that if that happens, the Fed they're going to be turning to rate cuts. I mean, they've done all these rate hikes. They're already at 4%. Maybe they'll hike 50 more. You get to 4.5% or whatever it is. They're going to be forced into cutting rates. And at the same time, if the recession is bad enough, you're going to get fiscal stimulus. I mean, nobody's talking about these things right now, but all these things are going to be huge catalysts for precious metals over the coming quarters. And, another point to the 2000 to 2002 comparison, Mike, you remember this. In 2001, the Dow Jones had, not the S&P, but the Dow had some pretty good rallies, and it was, less than 10% off its high. You probably remember that. Look at the Dow right now. We're seeing the same thing. So that happened in that bear market before the declaration of the recession, which happened sometime in 2001, I think. So yeah, there's quite a few similarities to that period, and I think 2023 could be a potentially really exciting year for precious metals investors because of how this is setting up. I mean, you see the market roll over again. Precious metals are going to make a big leg higher, and by the way, there's some people might be worried. Well, they think 2008 or COVID 2020, gold and precious metals could go down with the stock market. I mean, it's possible that could happen for a little while, but this is a completely different situation. And when you look at what happened in, I mentioned these 6 worst bear markets historically. If you look at 2 or 3 of the last 4, precious metals tended to bottom anywhere from 8 months to 12 months after the bear market started. So right now, we're basically 12 months in, and it looks like precious metals bottomed, 2 months ago? So there's all these, we can't know exactly what's coming, or we can't, forecast the future, but we're just looking at history. We're looking at the current data and all these types of things, try and get a sense of what could be coming. And looking at all these things, Mike, if the stock market rolls over again, but precious metals are going to do really, really well next year.
Okay, well, you make I always, I listen to different sources and to try to get different opinions. I don't want to get caught thinking one way and real rigid, then you run into a brick wall. But a lot of the things you are arguing make a lot of sense. But just for the sake of argument, how would you respond to this? One of the things that's happening is the yield curve is inverted, and that would seem to be evidence of your argument that a recession is going to come, and therefore these different market moves can happen. The yield curve inversion has been the most accurate predictor of a recession for like 50 years. However, the counter argument, Kathy Wood, the leading bull guru of our times, she is arguing that the yield curve inversion is not evidence of a recession, but instead is forecasting a complete and total collapse in inflation down to 2%, in the second half of next year. And therefore the Fed will be able to lower rates, and then there will be a complete and total boom in the economy and the stock market. And her argument for is that that the inflation in the economy is just temporary supply chain issues, and that people aren't understanding what she understands. It claims to is that there's a lot of technology and innovation and algorithms being created by people like Elon Musk that will make inflation vanish. So how would you respond to that sort of argument?
Yeah, I mean, that's interesting. I do agree with a fraction of what she's saying. I do think that, well, first of all, you're right about the yield curve. If you look at the 3-month versus the 10-year curve, the one that the most conventional one is the 10-year and the 2-year, obviously. But the Fed, one of the ones that the Fed focuses on is the 10-year versus the 3-month. And in the last month or two, that thing inverted badly, and it's diving lower. It's getting more and more inverted. Now, I looked, Mike, going back to 1966. That's, what is that, 30? It's about 55 plus years. I mean, you said the last 50 years, so yeah, you're right. I'll echo what you said. I looked at that going back to the mid-60s. Every time that inverted, there was a recession. So perfect track record. I do think inflation is going to come down, but the question is it going to come down to 2% like Kathy Wood thinks, or is it going to trough at 3% or 4% and then head back up? Because the problem is we have an energy problem. So whatever technology Kathy Wood is talking about, I don't know if that's going to produce a lot more energy. We're seeing we are going to see some historic shifts and transformations in the economy because we're moving away from an era of free trade. And so manufacturing and all that is going to come back to North America. So that's going to be more expensive initially, that transition. Labor has a lot more power now. If you look, Bernie Sanders might be the most popular politician in the country. I mean, he's at least the most popular Democrat. His approval rating is over 50%, while every other Democrat is basically at best in the 40s. So that should tell you how popular labor is. So I think, labor is going to have increasing power over the years ahead. And so that's more inflationary. And there's one other thing I'm forgetting, but so there's 2 or 3 key reasons that are going to, or I should say why there's going to be upward pressure on inflation over the next 10 to 20 years. Now, granted, if we're looking at here and now, right now, yes, inflation has peaked and the rate of inflation is going to come down. But the question is it going to come down to 1 or 2% like Kathy Wood thinks, or 3, 4, 5%? I tend to think it's going to come down to 3, 4, 5%. But here's the thing, Mike. Even if inflation comes down to 1 or 2%, that means the Fed is going to be cutting rates aggressively, which they don't want to do, and you're going to get fiscal stimulus again sooner than people think. Because if inflation is diving to 1 or 2%, that's going to have dire consequences for the economy. Like we're going to be in a significant downturn if that happens. So even if that happens, I mean, to me, it doesn't matter for precious metals right now. I mean, I think they're going to enjoy a really good next 12 months. Whether inflation comes down to 1 or 2% or 3 or 4 or 5%, I think they're going to win either way. So I disagree of most of what Kathy Wood is saying. But I mean, at some point, Mike, the bear market and the recession will end, and you will get, a rebound. And a lot of these ARK, Cathie Wood stocks, if they don't go to zero, they could have some really, really good rebounds, like we saw in tech stocks after 2002. There were tech stocks had a really good move from in 2003, 2004. But the problem is they were down 90% first. So I mean, you will get a rebound in a cyclical bull market in the S&P and tech stocks, but that's not where you want to invest over the coming years.
Yeah, well, that 2002, 2003 period, the things back then to have invested in were energy and the mining stocks, because they were kind of starting to both were outperforming the stock market in 2001, but they rallied more than even the tech stocks did. And obviously, as you mentioned earlier, can outperform up to 2011. The mining stocks did. But yeah, it's an interesting time. Thanks for taking the time to talk with me and everyone else. Could you tell everyone where to go to get more information from you?
You can go to my website at thedailygold.com. I have a premium service there, and I also put out a ton of free information, a lot of articles and videos and commentaries. So you can check everything out there at thedailygold.com, and I'll have a lot more good free stuff coming next year.